Okay, well, good afternoon, everybody. We're going to start the broadcast, and I'm Steve Parrish. I'm the co-director of the New York Life Retirement Income Center at the American College of Financial Services. Very much want to thank you for signing in. But first and foremost, on behalf of the American College, I just want you to know we extend to you our best wishes for your health and the health of your families. We hope you're weathering the storm adequately and that you will soon emerge for better days. I just don't think we can say that enough. So with that, though, let me set up what we're covering today. These ongoing webcasts that we've been doing for a few years on a monthly basis, they deal with retirement planning. And accordingly, sometimes our guests are like PhDs in finance, like last month. Sometimes they are tax attorneys, like where I'm coming from, and sometimes they are people who help people plan their retirement. And that's who we're going to be talking to today. So who we have is our guest is Jim Christian. I should say my guest and my friend is Jim Christian. His email tells you all about his career focus. I just love looking at when I get an email from him because it tells you what he puts his priorities on. It's Jim at JC Retire. So you know he's a retirement planner. Now, he's a great asset to have on our retirement planning webcast because he combines the practical of being at the retail level, a retirement planner in the Twin Cities, but he's also a known leader in the industry. In fact, that's actually where we met. I was on the board of directors of the Society of Financial Service Professionals, and he was our president at the national board of the FSP. So you got both a thinker and a doer. So today we are going to discuss how advisors can help their clients in a situation where the realities we face are obviously daunting, and it's not something we can look back that much in history for answers. We've got to look forward as well. Jim, I wanted to mention one other thing, or where he's coming from is we called the title of this Best Practices for Advisors in Uncharted Waters. Because when Jim and I first met, we realized we both were lovers of all things water-based, but we tended to appreciate the open waters from different angles. I'm an avid sea kayaker. Jim likes to take an upside-down approach, approaching the water from bottom up. He's been a diver all over the world, so I think he's well qualified to help us deal with these uncharted financial waters. So how's that for a cover photo? Welcome, Jim. Okay.
Thank you, Steve.
Yeah, great pick. Obviously, we're in a time of financial crisis and we're all looking for ideas and information. You know what? COVID-19 may be the cause, but the CARES Act is certainly one of the outcomes. In an ongoing effort to keep advisors and clients informed, we at the American College Retirement Income Center, we've been out and about in the public, virtually of course, providing commentary on all things related to COVID-19 and CARES Act from the financial standpoint. So Dr. Wade Pfau, Colin Slayback, and myself, we've been writing, speaking, serving as subject matter experts in a number of financial outlets like Wall Street Journal and Forbes, to consumer sources like New York Times and CNN. And for the many RICPs on this call, there's a lot of you, for those of you that responded to our 2 flash polls that we've had in the last couple months, a real sincere thank you. Your responses not only gave us the research information we needed to discuss retirement planning and the issues between advisors and their clients in the press, but I'll tell you what, it also gave us a chance to elevate the RICP designation to the world because we made it clear that our flash poll was interviewing experts who are RICPs. So if you're trying to keep up on what to read or want to know more about our activities in the journals and blogs and interviews that we've been doing at the Retirement Income Center, I direct you to the news center you see here at the American College for ongoing financial information. Okay, so to start for today, I want to take us back what seems like years ago, but is really just weeks ago, when COVID-19 and the CARES Act were not above the fold headlines in the financial press. Rather, the big issue at the time was Reg BI coming from the SEC. So the SEC's Reg Best Interest was scheduled to be effective June 30 of this year, and we were all dealing with the issues. And then we also had New York Reg 187 that was taking effective, and that was affecting life and annuity salespeople and advisors. And there were hearings in Massachusetts about making advisors subject to a fiduciary standard. This year, we also had the National Association of Insurance Commissioners coming out with a proposed BI, or best interest standard, for annuity sales. And by the way, Iowa, my home state, is now planning to adopt that. And all this now that I'm talking about is kind of below the fold in the press, with the CARES Act taking up all the oxygen in the room in the financial press. But guess what? Most of these actions are not delayed. Reg BI still takes effect June 30th, and the issues are only heightened because of the radically altered financial landscape that we got right now. So let's get to some questions. Jim, you've long been involved with financial service industry, including your tour as president of FSP. Now, we've seen both the feds and the states work on new rules for financial advisor conduct, many of which are to take effect this year, like Reg BI. But now we have I guess I'll call it shuttering effects of the pandemic. What are your thoughts as to where you think regulation of advisors will take us? Where's it going from here?
Well, as you mentioned, Steve, the regulation becomes effective June 30th. There's no delays in that, at least to this point. And it's going to involve additional transparency, disclosure, and documentation. But it's also important to remember that the aspects of this rule apply across both advisory and brokerage businesses. And frankly, I believe the broker-dealers will handle the disclosure and the compliance aspects as far as the four primary that you see on the screen. And the financial professional, though, so disclosure and compliance, the broker-dealers, it's the care and the conflicts that the financial professional is going to be tasked with, how to adopt, modify our practices and our procedures to meet that care and conflicts obligation, those obligations. What concerns me actually is the care obligation, because it really focuses on cost, but is silent on value that the advisor provides, or the services that the advisor provides. As a result, I believe this regulation will force, if they haven't already complied, to clarify and define their services and be more transparent on those services, which is most likely based on how much the client pays that advisor or firm. So I think the answer to your question, where is it going to take us? It'll take us further to refine our practices.
Yeah. Well, in fact, let's take both the service and the how we get paid element. I mean, let's talk about working in the client's best interest, and you still got to get paid. So we all know the story, but let's kind of review it. Some argue this means that you have to change to a straight fee so that all the advice is unaffected by compensation, and that's the only way you can work in their best interest. Now, others have argued that to align the client to the advisor's goals is the way you want to do it. So you want to tie the compensation to the portfolio performance, kind of the wrap fee type of approach. And then others have argued that in many cases, the client's really best served by the affordability that's offered by a commission approach. In other words, it's something that can be offered particularly middle class. Now, I'm confident of one thing, there's no one right answer. Otherwise, you wouldn't see what's happening with the BI reg that's come out, because it's being attacked on both sides. Some are saying, holy cow, it's a license to steal because it's so liberal and loose. Whereas others are saying, no, it's so restrictive, it's going to cut out the middle market from getting financial services. So Jim, I think we can agree that best interest doesn't just necessarily translate into the lowest cost to the client, but the cost of the advisor's comp is still a legitimate consideration. So since you personally offer multiple compensation models in your practice, and we'll talk about that later, but it's kind of nice because you you have kind of a balanced approach. Can you share with us the modeling that you've done? I mean, looking at a retail account versus an advisory or fee-based account?
Sure, and just a second before you flip that slide.
Mm-hmm.
It's kind of like democracy. It's not perfect, but it works. And I think compensation models, there's not one perfect compensation model, but they're perfectly acceptable based on parameters, I think, that the client, and maybe some of their preferences. But yeah, I'd be happy to go through that model. You want to flip that slide there?
Yep.
So I know this is a busy spreadsheet, and I'll explain it here in just a moment, but you might be surprised that the genesis of this spreadsheet was from finra.org, their website. And it's actually the mutual fund cost calculator enhanced, essentially. In fact, when I used that calculator as the base and then modified it, my broker dealer, the compliance department, questioned me a lot regarding using that tool. Ultimately, they approved the use. So then when I utilized this cost calculator, I had updated it, allowing varying input and withdrawal data. And I'll go through those details here in a second. And then, so my spreadsheet, the spreadsheet that we use, auto-fills the investment, the initial investment amount, the rate of return of both comparisons with the same data. So it's imperative to fairly compare these apples to apples. So where you see the initial investment, in this example, it was 178,000. So you populate it in one, it's going to populate in the other. The rate of return, it looks like it's 105%. The way the formula works, it's actually a 5% return. It's just the way you have to put the entry in, and that has to be the same. And then if there's a sales charge on your retail side, breakpoints, whatever it is, if you're using an A-share, then there's no sales charge perhaps on the fee-based. And then obviously add the operating expenses. And for the fee-based, you're going to add your operating expense plus any advisory fee included. So there's a gross number. And then whether there's a withdrawal or not. And I think the result of this, I'll get to that first, is it allows me to objectively compare a commission compensation method versus a fee-based compensation method. And the data allows me to take that information into account when discussing that client engagement. So if it's a short-term client, in I think the example here, you had $178,000, there was a break point, so it was down to 3.5. What's the break-even year there? I think it was year 5, and I'm going down the end of year balance after expense. Right. I think it was what, 212 after 5 years, 212.82. And on the fee-based side, line 5, 212.360. Right. So all things being equal, that retail is more expensive for the first 5 years and starts to pull ahead in the 6th year versus the fee-based, which would have been a better choice for a shorter term client in this example. Versus, hey, if it's a 20-year plan, as an advisor, we'd certainly make a lot more because I have that cumulative expense, which of course isn't all to the advisor. But this is just a tool that I don't know that this would be widespread use. We use it, and I'll share it with the client. In those cases where we're debating or discussing between those two different methods of how they prefer to pay for services.
So I guess, you know, in these webinars, we've had people make impassioned cases for one kind of compensation versus another. And that's why I asked you to put this up. I don't mean to put you in a box, but in many ways, your office is what's commonly called, you know, like a hybrid approach. So what's this translate into real life? How can you explain the compensation approach you offer your clients?
Well, I think we summarize it in a I think, the next slide, where we provide to our prospective clients and remind our existing clients, these are the 3 ways a client can pay for fees or pay for service: commission, fee-based, and flat fee. And we were doing hourly. We charged $200 an hour, and I got kind of tired of keeping track of all the hours. And we're looking for more long-term relationship clients. So I just recently, this year, modified number 3 to a flat fee, where it's an engagement for a year so that they get our communication schedule and all that. Those are the 3 ways. I don't know any other way that an advisor can be paid by a client. And it's my belief that the client best interest should include the client's ability and choice, quite frankly, to decide their preferred way to pay for financial planning services once they know the options are available. Now, whether the advisor or the firm offers more than one option is really the question. And is there one that's better than the other? One could argue there's pros and cons to all 3, but they are options. And, does this Reg BI, and I don't know the answer to this question, by the way, Steve, will it require, at time of enforcement, did the client have the ability to choose the method of how they paid the advisor? I have no idea. And there's nothing in the regulations on it. So
it's not covered. Yeah.
So the future is a little fuzzy in that area, because we just don't know how the enforcement will come.
Right, and one of the people wrote, why are they comparing? Why are they the regulators seeming to emphasize fee over commission? And I think that's been an interesting metamorphosis, where the DOL made it clear that commission were evil and fees were great, and then people started pushing back. And I guess we do know, at least with Reg BI, that it's meant to accommodate both. So we'll see where it goes. But the question did come up. I'm just going to throw this at you. You said, these are probably the big 3. There is this talk about subscription fees too. And I see subscription fees as being similar to a flat fee. It's just that the assumption is it's going to be ongoing rather than just a fee. And rather than have you respond to that, let's go to the next question, because that gets into service. Where the disagreements often arise is where you have, in these comp models, it deals with the actual service you're going to provide the client. So can you address how you address this issue with your gold service, bronze service model? Because I think that might help people realize how you can kind of go with this subscription method or other methods.
And before you jump to that slide, let me tell you why this came to be, because we had a number of legacy clients that would generate, $100 a year of recurring revenue, or $50, or maybe $200 or $300, and we were providing almost the same level of service for those clients that were paying us thousands of dollars per year, whether it was a fee-based account or commission trailed account. And it forced me, it wasn't fair, it wasn't in the client best interest for somebody that's generating $100 a year to get the same service that a client's paying us several thousands of dollars a year. So if you flip to the next slide, it took a while, but this is part of the engagement in the ongoing client service process that really took quite a while to develop and refine. So our service level platforms simply define the services we promise to provide. However, it's the actual consistent delivery of those services and frequent client communication with clients. It's where the value and the loyalty and commitment is developed and maintained is delivering these services. There's more under the hood on this than just what this describes. But it's critical that we remind clients of their platform with this document. And we actually do that with every written annual review. And they might ask, well, geez, Bronze, you're only servicing my existing accounts, but I want comprehensive planning. Well, your accounts don't generate enough revenue. So either you invest more money, we charge fees, then we add additional services. And as you go up to the gold, and clients do actually ask, what does it take? How much money do I have to invest? And one of the downsides of having multiple compensation or accepting multiple compensation methods is they'll say, well, what's your minimum? And I'll say we don't have a minimum, because all advisors, whether we admit it or not, we base our service, or should be basing our services, based on how much revenue the account generates, not the size of the account. And if I have a $100,000 account in a fee-based and I'm charging 1%, generating $1,000 a year minus whatever the broker-dealer haircut is. If I do it in a commissioned account, I might generate a $4,000 upfront commission, and then I have maybe a $250 a year trailing commission. Right. So what we do in our practice is we'll take that $4,000, divide it by 6 for 6 years, and say, oh, okay, that plus the trailing commissions is how much recurring revenue that client's account generates, and that will qualify them for those platforms. So we just set levels for what's a bronze, what's a silver, and what's a gold. And the compliance department said you cannot put dollar amounts on that. So it was like, okay, we'll just tell the client. So that's what we do in our office. And our goal is to build 200 gold and silver platform clients. We service about 300 total clients, and we've got capacity for about another 70 in the gold and silver. So that's what we're doing for providing service and making it clear so clients do know what to expect and it's measurable.
So let me, I'm going to throw the objection that some people might have. I mean, I love the upfront approach because that way people know what their service level is going to be. But what happens if it's kind of, well, I don't know what need I have until you tell me what I need, that type of thing. Because some people might say, well, you don't see a physician or a dentist offering gold, silver, and bronze level of services unless maybe in the fillings themselves, just occurred to me. But how do you address that issue with them?
Well, that's a great question, Steve. I think because we do comprehensive planning, most clients aren't comfortable, much less confident, with every aspect of the 5 key financial planning areas. And I call it PERTI as my acronym, PERTI, protection, estate planning, retirement income, taxes, and investments. And secondly, there's a lot of activity and threats that are in those 5 planning areas. So what we do is like this gold, silver, and bronze services summarizes. On the back side of that document is this next slide that you just brought up, which was the comprehensive planning. See the 63 potential planning boxes? It really, when a client sees that, they go, oh my gosh, it makes the impression this is kind of complicated. There's a lot of stuff. And I assure the prospective client or our existing clients that we'll take one step at a time. I have to tell you a funny story related to this. There was a billboard here in the southern part of the Twin Cities that advertised a plumbing company that showed a bunch of leaking pipes in this house, and this frantic homeowner was attempting to stop the water. And the tagline on the billboard was when DIY becomes OMG. And what we do is, you can do it yourself, and there are clients that are great at doing it yourself. They're not our client. We want the client, and we provide the most value and service for clients who need, want, and appreciate the work we do, and a desire for a long-term relationship, as I'm sure other advisors out there. Not all prospective clients are good fits for our practices for one reason or the other. They're either very skilled or have great interest, or we have selective clients that we really align ourselves with. So I think what's different from comprehensive advisors and those listening to the conversation here is we do a lot. A dentist does teeth, and I'm not discounting what dentists do or doctors do, because they do a lot. They keep us healthy. But there's a lot of additional risks in our own financial plans and our clients' financial plans that takes a lot of multidisciplinary professionals to address. And I don't think the average consumer is blind to the amount of risks, because they seek us out typically. So I think that's where we offer at a different level, because people have different levels of service based on how complex their situation is and what they really want for ongoing support and service.
Well, we had one person saying, well, really, what's this have to do with dealing in a recession and COVID-19? And we do want to get to that. We want to just kind of put a face to it, that that's the very thing we're running into right now, is what services do you provide? You really have to start defining it when you have the kind of crazy financial environment we have right now. So as we transition into how we deal with the crisis, let's look one step beyond the crisis, because I know you've been involved in a coaching group for some time, and so it might be good to talk a little bit about how that works and what you do with that, because that might remind us that hopefully we will be in a situation where once again getting ahead of things, rather than just the trying to keep our head above water situation right now.
Yeah, that question, how do commissions versus fees relate to a recession and best practices? This next section is key, because we did that underlying stuff. I don't know how practitioners have their practices developed, but improving our practices once we emerge from this crisis is the wrong question. Rather, what are the ways we serve our clients during these volatile or scary events like what we're experiencing now? And it's critical that our systems, our practices, can deliver what's needed. I do a talk titled Life Lessons from the Edmund Fitzgerald that tells the story, for those that might remember it, of the 1975 shipwreck in Lake Superior, with all 29 men lost and never recovered, by the way, that really parallels that shipwreck with our lives and the importance of preparation, planning, and maintenance. And during times like that storm for the Fitz, or during this coronavirus pandemic, the importance of being prepared, having the systems in place in our practices. And what do we do with our clients and for our clients prior to these events, and then keeping ourselves sharp? So my coaching with I use the Academy of Preferred Financial Advisors, APFA, and the numerous other advisors in that program to help me define, refine, systematize, and of course be held accountable to the services and communication that we provide to meet and hopefully exceed our clients' expectations. And it's exactly times like this where your value as an advisor, my value as an advisor, will either make or break that client relationship. And I want to be that advisor during these times that actually increases my business, because we have such a systematized but caring process to service those clients when it's frightening. People are afraid. We're stress testing clients' portfolios. It's like, am I still going to have enough? And the value that all of the participants on this webinar and beyond, you are so valuable to these clients. When they're afraid, it's an honor to be able to serve in that capacity. So the value and the importance of how you get paid it's important, but it has to be sustainable. So having an established system that you can provide the level of service and have those loyal clients for your lifetime or for their lifetime is really critical now more than ever.
Yeah. Well, in fact, let's go ahead and transition specifically into retirement planning in this current environment we have. And I thought a good place to start is product versus service. So I recently heard someone say, to be a good planner, you really have to be ambidextrous, meaning you got to be able to work with both hands, both service and product. Or as you more eloquently have said it in the past, you have to be agnostic and non-biased. But now, with all that's going on, this whole product debate becomes particularly important because I don't think we'll leave unsaid who says it, but we know about advertisements that say I don't believe in annuities. Well, right now there's some people with annuities are pretty happy, but on the flip side, I'm hearing, well, considering these crazy times, you got to be crazy to invest in stocks. So let's just put it this way: we talked about your service approach. How do you deal with products in your practice?
It's hard to be agnostic or non-biased with regards to products, because if you don't necessarily believe something because you don't know it. And I work hard to view products as tools, and I embrace all tools for what they do and not what they are. Again, I embrace tools for what they do and not what they are. So the example is, I had gotten, let's just use this hypothetical. I've got to dig a hole and I've got a shovel and a hammer, but I hate hammers. I just don't like hammers. So if I'm going to dig that hole, I could dig it with the shovel quite easily. But if I hated that shovel and I needed to dig a hole, I could dig it with the hammer. Certainly wouldn't be very efficient or fast for that matter. But is that bias? I know that's a crazy example, but apply that to products. Hey, I'm an ETF person, or I'm a mutual fund, or I'm an index person, or I'm an annuity. All of one thing is, we teach diversification in investments. Think of diversification in retirement income strategies, retirement income products. And, know the best tool, the best use for each tool, and know what tool mitigates risk. You mentioned it, Steve. This is a volatile time. Those with pensions and Social Security, or maybe they've got settlement options, or they have annuity sources, they're not worried about that part of the income. They're worried about the risk-based assets that are providing income and the threat of dividends and all that being decreased. But that being said, there are some investments like options, futures, and commodities I'm certainly not comfortable with, and admittedly disclose to the client and refer them to others that specialize in those products too. So I think the parameters of case design can determine which retirement income strategies are utilized, as well as aligning the risks with product allocation. And lastly, explaining and having clients understand both promise-based income and risk-based income investments is critically important.
Yeah, makes sense. Well, let's talk about the situation on the ground right now. So, number one, we have a financial crisis on our hands, and people are, as you've said already, they're scared. Two, we have the potential, I just want to mention, of higher taxes. I don't know, but you'd think we might have higher taxes to pay for reduced government revenue because of unemployment and increased government expenditure from the CARES Act, obviously. And then three, we got the quite possible scenario of a recession. So that's kind of where we are. So first, how are you communicating with your clients about this situation? And by the way, one of the people asked particularly, how are you communicating? Because you have to social distance. So how are you dealing with them on that? How's it going?
Yeah, let me answer that question. And a question came up in the chat. How do you plan to do events while social distancing? They tie together. We just did a webinar we did one Monday and then one before Thursday. It was just an economic update. Again, we did a Zoom meeting. We're calling our A and B, our gold and silver, our A and B clients, but calling them on a personal basis. And we'll hopefully be able to do client events face-to-face in a month or 2 or 3, hopefully. We'll see. Otherwise, we're just going to do it virtually. I think the first thing that we do is regularly provide clients with kind of historical macroeconomic information during a scary time like this. Like the example here is the 60-year history of the volatility, whereby the S&P dropped from, let's see, February 19th to March 23rd, it dropped 34%. Well, that clearly falls in the bear market. And we just tell clients, we've had 8 of these in the last 60 years. This is number 9, presuming that the March 23rd was the bottom, or at least we hope it was the bottom. And average peak to drop was 26%. We just beat that to 34%. Now it's come back, and you'll see that in a moment, a little bit. How long do they last? And what's the average recovery in months? We've been here before, and reassuring clients that you can live through this. The key is we don't want a dollar cost ravage the portfolio. Let's not be selling shares when they're down 10, 20, 30%. Have enough retirement income strategy that has the products or the tools that can ride through these periods and let the equities be equities and let them come back and sell high, don't sell low. So this is the macro part, just to give clients a sense of, hey, this happens all the time, and gives them some sense of expectation. Again, this recovery might be longer or shorter than previous ones, but at least it gives perspective.
And then I just learned something. So dollar cost ravaging instead of dollar cost averaging. I'll remember not to do that.
Yeah, it's crazy. I mean, there's one mutual fund family that when they do RMDs, if you've got 5 holdings and they're 20% each, yep, and you need $1,000, they're going to sell $200 worth of each one. And I'm thinking, well, the ones that are down the most, they're going to have to sell the most shares. And it's like, that's exactly opposite of what we should be doing. So we tend to put money in brokerage accounts. So we've got a cash account, and we've got selected holdings that we can define where that money comes from.
Right. So you give them the big picture of the volatility, and then I was going to pull up your sample letter that you do as far as communication directly with the client.
Mm-hmm. So this slide is part of every annual written review. We do at least an annual written review, and more frequently for some selected clients. And then we'll do an in-person, or now we're doing virtual review meetings. We do this for our gold, silver. We actually do it on we don't get this much detail for our bronze clients, but we do our gold and silver, which includes a history of their personal economy, not the market, because they'll compare themselves to the market, the S&P or whatever. And it's like, you're not the market.
Right.
And we do it both in dollars and in percentage. Green is good, red is bad. Stocks go down faster than they go up, but stocks go up more than they go down. And is there more green or red in your portfolio? And the paragraph to the left there, this is an example. I did this one. I just did this review April 16th. And the data is, I remind the clients, you've had great gains, you've had significant losses from time to time, but this client's accounts were up $104,000 or 17% in just 17 trading days since March 23rd. I am not smart enough to time that market. I want to be defensive, and this is a moderate portfolio client that we use. So I believe it's helped condition our clients that these periods do happen, and they've lived through them in the past and will so again. As long as we use the tried and true fundamental planning and investment strategies, including a disciplined distribution strategy, not dollar cost ravaging, that doesn't ravage that portfolio when the prices are down, this counsel and keeping the client from panicking helps clients psychologically and emotionally better cope with the worry, fear, and panic they might have. In diving, we always talked about the 3R rule: regain control, respond, and react. Fear is good, but panic is deadly. And we do this year after year. It's the same content, and it gets revised a little bit, but we specifically go back to 2008 because it was such a horrible, that was one of the mega bears. And I think it gives clients perspective. We have not had that many calls. We do get calls, but not like we used to before we started doing this. And I think it's, in my opinion anyway, it's been helpful. It's helped calm clients through these storms.
And for the many people on the line that are RICPs, when we did the flash polls, we found the experience was much like Jim indicated, where yes, they're getting clients, and we did the second poll, and they're getting calls, I should say. But when we did the second poll, they're getting more calls, but they still aren't getting the big sense of panic that might otherwise come. So let's assume, you got them calmed down with all the great things you showed, but you still got the reality that we've got this crisis without a known end date, and we have the possibility of higher taxes, we have the possibility of recession. Any other thoughts for big picture, how you deal with that? I mean, what do you pass on to people about this issue?
Reminding clients it's temporary, it's indeterminate in terms of how long this might last. When's the vaccine going to be, available? And then we remind clients these are temporary periods, they're not permanent, and we'll always review their financials. We'll look at their net worth statement. How much do you have in cash? What's your average, how much income? Do you have enough money to live through this period if they're still working? Are we going to use reserves? Do we need to, start having dividends pay to the cash so that they can take income off of the investments instead of having reinvest? And let them know that they're going to be okay. I hate it as much, if not more, than clients when the portfolios are down.
Yeah.
But their concern is, will I have enough? Am I going to run out? And remind them what we've built, that plan that is going to get them through this period of time. And just being there for them, and just always remind them, you've been working with us to be prepared, and I know you'll be scared, but you are prepared, and we will be there with you throughout this, as I'm sure the other advisors that are participating in this talk today are providing a high level of service for those clients that we love and care about.
Yeah. Well, good. We're about ready to go into some questions, but I did have another question that I think is highly important. You know what? We're going through tough times. We got to remind ourselves that there is an end to this, and we're going to have fun. And you and I have this common interest in outdoors. You scuba dive and you hunt and whatever else. But I'm just kind of curious how you're going to get back into your extracurricular activities. I mean, we have to remind ourselves we're here for more than just dealing with panic. So I'm going to put up the slide and ask you a question here. Hopefully people can see this, but I believe that is you in your diving gear and some people helping put you in a hole where, let's just assume there's water there. I'm broadcasting right now from our other place that we have in Florida, and I'm assuming you're in Minnesota, and so probably the weather looks like that right now in Minnesota. What's going on here, and how are you gonna get back at this?
All right. So the explanation of that slide there, Steve, is this was in February a few years ago here in Minnesota, and the ice is out. The ice that year, that's a triangle cut in the ice. You can just see the one corner of it there. Yeah. That was 2 feet thick. It was a fairly cold winter. That was below zero. It was very chilly. So the woman in the photo, her name's Lisa, and that's my dad. They were assisting me. So Lisa had dropped her $400 prescription sunglasses through the hole in the ice. She was ice fishing inside that house that has that ice fishing house that has the shovel leaned up against it. She looked in the hole and her glasses dropped off. And so she called me. She knew I was a diver. And I said, you know, I haven't been ice diving in a while. I'll go down there. And it was only like 14, 15 feet of water. And brought my chainsaw, 32-inch bar, got the hole cut, got the ice out of the way, and got in, jumped in the water. And you can barely see it, but by my dad's left foot there's a rope. And I went down with a safety rope so that I could find my way back to the hole, because the visibility, I couldn't see my hand in front of my face. It was really dark. So it's challenging myself in diving situations. I did find the glasses and got them back to her, and she gave me some chocolate chip cookies, so it was a great deal. But diving like that really keeps my skills sharp, challenging, because obviously the water was just a little bit above 32 degrees. But we don't get smarter, we don't get stronger or increase our endurance unless we challenge ourselves. Periods like this economic time challenges our practices, our careers, and we need to learn from those experiences and get stronger and be better. And so it applies to us professionally, but then I apply some of those lessons just with the extracurricular activities, so that we're always moving forward and getting better for ourselves and for our families and for our clients.
Excellent. Well, good. What I learned from this is never agree to put up a picture without knowing what the source of it's going to be. So, hey, first of all, before we go into questions, I just want to say, you know, this has been, I think, really enlightening, because in times, challenging times like this, we just have to look at the big picture, but we also got to look at the best practices. And I'd like to think you've given us some of those. And frankly, it's a learning process. Right now, we're doing a lot to learn. So I just want to encourage everybody that's listening. The RICP designation, Retirement Income Certified Professional, seems more valuable than ever. And the flash polls have kind of proven that the RICPs out there, their clients, by and large, aren't getting crazy, aren't panicking, but do want the information we can provide. So I always encourage you to go ahead and do that. One other thing before we do some questions, I just want to tell you our next webinar is going to be June 9th at 2 p.m. on Medicare. It's going to be Dan Mangus. He's going to be talking about Medicare in light of the COVID-19 crisis, which obviously is germane to what we're talking about. But I do want to mention, in case you haven't seen it, is the American College is also doing these webinars on financial planning during a pandemic. And indeed, we have one coming up tomorrow about this time. So I want to encourage you on that. Okay. As far as questions, for those of you that listen to these know that I do get back on some of the more specific questions that are asked when we run out of time and that kind of thing. So if I don't get to it right now, know that I'll do my best to answer your other questions. One I wanted to discuss just real quickly is this whole idea of a subscription. What we're finding, I teach estate planning to lawyers, and the law community has been moving very much to a subscription base that starts with a letter of engagement where they say, look, here are the services we'll provide. So they won't necessarily say gold, silver, bronze, but in other words, here's what we do. If it's just a estate plan that's a will and a trust, we're going to do the will and the trust and we're done. If it's ongoing estate planning, so that when the Secure Act or the CARES Act comes in and we're supposed to keep you up to date on that, we can do that, but then we're going to charge essentially an ongoing fee. So I just wanted to comment that we are seeing more and more in financial services and retirement planning a move not only to fee, and not, by the way, against commissions at all. Again, as Jim pointed out with his model, there's different ways to do this, but not only fees, but kind of a subscription. And Jim, do you have anything to add to that before we move on?
I don't, but I've attempted to do some subscription. I'm not quite there yet, but.
Okay. Yeah, and just it'll be interesting to see, but if we're supposed to be acting in the best interest of our client, defining it with that letter up front, letting them know the services, disclosing commissions is going to get more and more important. And by the way, one of the questions that came up for you, Jim, is we've been talking about how you get paid, but that's not always how much the client has to pay out of it. So what happens when the fact is, how do you disclose to the client your compensation when there's a haircut being taken for the BD or that kind of thing?
Oh, we tell them. We tell them, here's the, you look at your Morningstar report, here's the 12B1, or here's your expenses. Here's what we get paid if it's 25 basis points, if it's an A share. We just say 25 basis points on 100,000 is $250 a year. Then the broker dealer takes their haircut. So we end up with, we have about a 92% payout. Then I tell them that's what we get paid.
Okay, so it's the whole thing, not just part of it. Mm-hmm. Just looking at some of these regarding the client review numbers, how do you account for and show cash flows in and out of the account? So we've kind of been talking about more about accumulation than accumulation and distribution, kind of when they go into the decumulation period of retirement.
We do for our A and B clients, we do a net worth and cash flow, one page Excel, simple, shows ownership, the account value, and the values that they provide for us. Obviously, the ones that we manage are verified. Those are all theirs. We just review their cash flow. We don't account for their distributions in that, like that review summary. There's
right.
Another question I want to tie into here. It says, how do you factor in promise-based income in the review and acknowledge the client fear and review history letter? We don't, on that review part, we don't include the withdrawals. Some clients that we do that for are those that are rapidly depleting theirs. They're doing 7, 8, 9% withdrawal rates. We're constantly reminding them, here's how much it grew, and then we have a column just to the right of that, of the value, the value or how much was gained or lost in that return, or lost. Mm-hmm. We'll actually put the withdrawal there because we remind them how many more months or years that will last before it's exhausted. So we just keep the cash flow. They're responsible for the cash flow, and that shows up on their cash flow sheet, which is one of the documents in their written review.
Okay. And by the way, go ahead.
And then the other one that came in, how do you factor in promise-based income in the review and acknowledge client fear and review history letter? Well, we don't include that in that. But again, that would be in the cash flow sheet, and just a reminder of whether it's Social Security, pension 1, 2, or 3. If they have an annuity or rent income, it's going to show up on the cash flow. And I think one other really important point, if you do a cash flow for your clients and you have, you know, husband, wife, or wife, wife, husband, husband, whatever, you have a couple, absolutely include husband alone, wife alone, you know, separately. What's the financial impact of that cash flow for them individually? Loss of Social Security, maybe loss of pension, and so on. That is always a good reminder, especially for legacy planning, because it's not just kids and charity. Legacy after the first person dies is probably going to be the spouse first. That's a good way to document that.
Okay, and remind us, because it came up, what are the 5 planning areas? What's the acronym? I do like that.
PERTI, PERTI, protection, estate planning, retirement, income, taxes, and investments. You know, we tell clients, we won't prepare your taxes, but we'll help you save taxes. So our clients will provide us a tax return. Most do, and then we will review that and see what areas we can help in minimizing taxes by just tax bracketing, Roth conversions, taking, you know, gain loss, selling.
Right. Okay, well, I think we covered a lot of them. Any other questions, I'll work to get that out to you. So I really want to thank Jim. Again, I think we had big ideas, but also the best practices all in there. I really want to thank you for your time and your expertise and all that you've done for the industry, Jim.
Thank you.
Okay, and thank you all to the audience, and everybody. Stay well, be well. We'll talk to you next month. Thanks.